taxation in economic policy. Introduction. Taxation is a fundamental aspect of economic policy that influences the functioning of economies worldwide. Governments use taxes as a primary means of generating revenue to fund public services, infrastructure, and social programs, while also attempting to shape broader economic outcomes. The design and implementation of tax policies are critical tools for influencing economic growth, redistributing wealth, and managing inflation. The balance between tax rates and economic growth is a complex issue that policymakers must carefully navigate to ensure both the sustainability of public finances and the efficient functioning of the economy. In this article, we'll explore the role of taxation in economic policy, examining its various functions, effects, and the challenges that come with effective tax policy implementation. The primary role of taxation: revenue generation. At its core, taxation is the main source of revenue for governments. Taxes are collected from individuals and businesses to fund essential government activities such as defense, education, healthcare, and infrastructure development. Without a steady stream of tax revenue, governments would struggle to provide the necessary public goods and services that maintain societal welfare. Types of taxes. Taxes can be categorized into direct taxes, income tax, corporate tax, and indirect taxes, sales tax, value-added tax. Both types play central roles in the revenue generation process, and their design influences economic behavior. Progressive versus regressive taxation. Progressive taxation, where higher income individuals are taxed at higher rates, aims to reduce income inequality. In contrast, regressive taxes, which impose a higher burden on lower income individuals, can exacerbate inequality if not designed with care. Taxation's role in revenue generation is fundamental for government functioning, and its adequacy and fairness are critical in determining the overall efficiency of an economy. Taxation as a tool for economic growth. Governments can also use taxation as a tool to stimulate or slow down economic growth, depending on the prevailing economic conditions. By adjusting tax rates and introducing various tax incentives, policymakers can influence business investment, consumer spending, and employment levels. Tax cuts to stimulate growth. In times of economic recession or stagnation, governments may lower tax rates to boost disposable income for consumers and increase profits for businesses. This encourages spending and investment, which in turn can stimulate economic activity. Tax incentives for investment. Tax credits and deductions for businesses, particularly in research and development, can stimulate innovation and investment in productive sectors. These policies are often used in high-tech industries or sectors where long-term growth is critical. Progressive taxation to promote equity. By taxing the wealthy at higher rates, governments can redistribute wealth and reduce income inequality, which can lead to a more stable and sustainable income in the long term. A more equitable income distribution can boost overall demand and economic stability. While taxes can drive economic growth by creating favorable conditions, policymakers must be careful not to overtax businesses and individuals. It could stifle economic activity. Taxation and inflation control. Another important role of taxation in economic policy is in managing inflation. Taxation can be used as a tool to control the amount of money circulating in the economy and curb inflationary pressures. Increasing taxes to reduce inflation. When an economy is overheating with high inflation rates, governments can increase taxes to reduce consumer spending and business investment. This contractionary fiscal policy helps cool down an economy and stabilize prices. Targeted taxes on specific goods. Governments may introduce specific taxes on goods and services that are considered luxury items or products that have an inflationary impact. For example, taxes on fuel or property may be used to reduce demand in sectors that are experiencing rapid price increases. By managing inflation through taxation, governments can help maintain purchasing power and ensure economic stability. Taxation and income redistribution. Taxation plays a central role in redistributing wealth and addressing social inequality. Progressive tax systems aim to reduce income disparities by taxing higher incomes at a higher rate and using the revenue to fund social services for the less fortunate. Welfare programs. Revenue from taxes is often directed toward funding social welfare programs such as unemployment benefits, healthcare, housing assistance, and education. These programs help support lower income groups and provide a safety net during economic downturns. Public services. Tax funds also finance public services such as transportation, law enforcement, and emergency response systems, which benefit all citizens but are particularly essential for disadvantaged communities. Taxation in this context acts as a mechanism for reducing income inequality and promoting social mobility. The relationship between taxation and business investment. The impact of taxation on business investment is a critical consideration in economic policy. A tax system that is too burdensome can deter businesses from investing in expansion, innovation, and hiring. Conversely, a favorable tax environment can attract investment, stimulate job creation, and enhance overall economic productivity. Corporate tax rates. Lower corporate tax rates encourage businesses to reinvest their profits, potentially increasing capital formation, expansion, and job creation. Capital gains taxes. Capital gains taxes, which are levied on the profits from the sale of assets, affect investment strategies and long-term economic growth. Reducing capital gains taxes can incentivize investment in the stock market, real estate, and other areas of the economy. Tax credits for research and development. Many countries offer tax incentives for businesses that invest in R&D, allowing companies to offset the cost of innovation and encouraging technological advancement. A tax policy that strikes the right balance between generating revenue and promoting business investment is crucial for fostering long-term economic growth. Taxation in a globalized economy. In today's globalized economy, taxation plays a crucial role in ensuring that businesses and individuals contribute to the economic well-being of their home countries, even as they operate across borders. International tax cooperation. Globalization has led to the rise of multinational corporations that operate in multiple countries. Governments are increasingly cooperating through international tax treaties to ensure that businesses pay their fair share of taxes, while preventing tax avoidance and double taxation. Tax havens and evasion. Some businesses and individuals exploit low tax jurisdictions, tax havens, to avoid paying taxes in higher tax countries. This creates challenges for governments trying to collect fair tax revenues and manage their economies effectively. Global tax policy, therefore, must adapt to the complexities of cross-border operations and ensure equitable taxation for all actors in the global economy. Environmental taxation. In recent years, governments have been increasingly using taxation to address environmental concerns. Environmental taxes, or green taxes, are designed to promote sustainable practices and reduce the negative environmental impacts of certain industries and activities. Carbon taxes. These taxes are levied on the carbon content of fuels, incentivizing businesses and consumers to reduce carbon emissions and adopt cleaner energy alternatives. Pollution taxes. Taxes on pollutants such as industrial waste emissions and water contamination can encourage industries to adopt cleaner technologies and reduce environmental harm. Incentives for green investments. Tax credits for renewable energy investment and environmentally friendly practices are often used to encourage businesses to transition toward greener alternatives. Environmental taxation provides a dual benefit. It reduces harm to the environment while generating revenue for governments to invest in sustainable development projects. Tax evasion and compliance. While taxes are a fundamental part of economic policy, tax evasion remains a significant issue for many countries. Individuals and corporations sometimes seek to evade paying taxes through fraudulent means, such as underreporting income or inflating expenses. The role of tax authorities. Governments invest heavily in tax authorities to combat tax evasion and ensure that taxes are collected fairly. This includes using data analytics, audits, and international cooperation to identify and prevent tax fraud. Encouraging compliance. Transparent tax policies and affairs to simplify the tax system can help reduce tax evasion. Governments also use penalties and legal action to discourage individuals and businesses from evading taxes. Tax compliance is essential for the effectiveness of taxation in economic policy. Without it, governments would struggle to generate the revenue needed for public services and economic stability. The impact of taxation on consumer behavior. Taxation influences consumer behavior by affecting disposable income and the prices of goods and services. Indirect taxes, such as sales taxes or VAT, are particularly significant in shaping consumer spending patterns. Consumption taxes. Sales taxes and VAT increase the price of goods and services, which can lead consumers to change their purchasing decisions. High tax rates may discourage spending on non-essential items, affecting businesses in those sectors. Excise taxes on specific goods. Taxes on items such as alcohol, tobacco, and sugary drinks are intended to reduce consumption of harmful products while generating revenue for health initiatives. These taxes are examples of sin taxes, aimed at modifying consumer behavior for public health purposes. Taxation is a powerful tool for shaping consumer behavior, particularly when it comes to promoting healthier lifestyle or curbing overconsumption. Taxation and government debt management. Taxation is directly linked to a government's ability to manage its debt and maintain fiscal stability. Governments rely on tax revenues to service national debt, pay interest on loans, and reduce deficits. Deficit financing. If tax revenues are insufficient, governments may resort to borrowing to finance budget deficits. This can lead to higher national debt, which needs to be managed carefully to avoid economic stability. Debt to GDP ratio. A country's tax revenue relative to its GDP impacts its ability to sustain government debt. High tax revenues typically provide governments with more financial flexibility to manage debt and invest in long-term growth. Tax policy must be carefully balanced to ensure that it provides enough revenue for debt management while avoiding excessive borrowing that could hinder future growth. The complexity of tax policy design. Designing an effective tax policy involves balancing competing objectives, including economic growth, equity, efficiency, and simplicity. Policymakers must consider the specific needs of their economy, the distributional impact of taxes, and the administrative costs of implementing and enforcing tax laws. Simplification. Simplifying the tax code can improve compliance and reduce the burden on both taxpayers and tax authorities. Complicated tax systems often lead to confusion, inefficiencies, and higher costs for governments. Equity and fairness. Tax policies must be designed to ensure fairness, taking into account the ability to pay. This is particularly important when dealing with progressive taxes and wealth redistribution. Achieving an optimal tax policy is an ongoing challenge for governments, requiring constant adjustments in response to changing economic conditions. The political economy of taxation. Taxation is not only an economic issue, but also a political one. Decisions about tax rates and tax structures are heavily influenced by political ideologies, party platforms, and interest group pressures. Taxation and voter preferences. Politicians must consider the preferences of voters, who may be more likely to support tax policies that benefit them directly or reduce their tax burden. Corporate lobbying. Large corporations often lobby for tax breaks and incentives, which can influence tax policy in ways that benefit business interests, sometimes at the expense of the broader public. The political economy of taxation plays a significant role in shaping the tax policies of a country, and understanding these dynamics is essential for creating effective tax systems. The globalization of taxation. In an increasingly interconnected global economy, tax policy is influenced by international trade, investment flows, and multinational corporations. Globalization has created both opportunities and challenges for taxation systems. International tax avoidance. Multinational corporations often engage in tax avoidance strategies by shifting profits to low tax jurisdictions, making it difficult for governments to collect fair taxes. Efforts by international organizations such as the OECD aim to combat tax avoidance through coordinated regulations, cross-border trade, and taxation. The rise of global trade has prompted governments to reconsider their tax policies to address issues such as tariffs, transfer pricing, and the taxation of digital businesses that operate internationally. Global tax coordination is increasingly important to prevent tax avoidance and ensure that all actors in the global economy contribute fairly to national tax revenues. Conclusion: taxation plays a central role in shaping economic policy, influencing everything from government revenue to business investment and consumer behavior. It serves as a tool for promoting economic growth, reducing inequality, controlling inflation, and funding essential public services. However, designing an effective and fair tax system is complex and requires careful consideration of various economic, social, and political factors. As economies continue to evolve and globalize, the role of taxation will remain central to the ability of governments to promote sustainable development and ensure equitable outcomes for all citizens.